Paul, the failure of Silicon Valley Bank has sent ripples throughout the financial system across the globe. It didn't have to happen, you've said. What do you mean? Why didn't it have to happen?
Anthony, the crisis, the failure was completely avoidable. It was a failure of management. It was a failure of proper asset liability management. And what that means is that the, the bank had taken in enormous short-term deposits. And as quickly as those came in, they could go back out. And guess what? They did go back out that quickly. But in the meantime, they used substantially all of those funds to buy very long-term dated assets, most of which were very high quality, not all, but that was a mismatch. And when the rate rise started, the program of raising rates a year ago by the Federal Reserve, the company did not respond to that like they should have. They should have been liquidating those assets. They should have been taking out derivatives contracts, basic good asset liability management, and paying much, much more attention to the unique features of their customer base and the nature of their wholesale deposits, not retail deposits. These were corporate deposits. They didn't do any of those things. They made many other, let's call them smaller mistakes too. Completely avoidable.
So this is a fast-moving story, but as we sit here right now, you've led 3 meetings of NeuGroup members who are grappling with some of the consequences of this bank failure and perhaps signature banks as well. What have you taken away in terms of observations about what position this put our members in, or some of them, and what they did well, or maybe have learned that they should have done earlier before? What are your takeaways?
Well, you mentioned the 3 crisis sessions that we've run so far. And Anthony, you can see that they were 3 very distinct sessions. The first one on Friday, which we put together right at the last minute in the middle of the crisis, was all about really basic things like, can I still get my money out, or how much money did, because some members did get a lot of money out. Are any payments going through? What can we do? What do we do about payroll? How do we block making payments to SVB accounts that are held by our employees for payroll, or by our suppliers that we're going to be paying, and so on. So really, really operational questions, and everyone was more or less flying blind, but the members were helping each other out. And the members that were most directly involved, because they had actual accounts and where SVB was an important bank to them, they were helping the other members who were a little bit more peripheral. So the Monday meeting was very different, because by this time, of course, the federal agencies had intervened, and there was a lot more relaxation. So the first half of that call was focused on also operational things, and especially things that were now getting more light, like multi-currency accounts, and where's that money, and who controls that money? Is it the correspondent bank, or is it SVB? Letters of credit. Are beneficiaries coming in to ask for a replacement to SVB? Is there activity within SVB, or is it closed? Things like that. But the second half of that call was bigger picture focused. It was basically, let's call it contagion, right? What does SVB and the other US banks mean for the US banking system? Is this going to spread overseas? And the call that we ran today was really tidying up, I would say, the operational aspects, because now things are flowing again. The portal is working again just fine, and most payments are going through, some delays, etc. And there are still questions around FX, still questions around multi-currency accounts, still questions around letters of credit, but things are up and running. And then again, the second half of today's call was all about contagion and what this means. And I would say on both of these more recent calls, we did spend time with members talking about their watch lists, how they look for counterparties that are potentially in trouble, how they monitor that, and what the process is.
Right. I do want to look ahead a bit, and obviously, neither you or I or anyone has a crystal ball to see how this is all going to play out ultimately. But knowing what we know today, what do you think the lessons are here for corporates about their relationship with their banks and what their banks own, and how they might, prepare better for the next Silicon Valley bank?
I would say redundancy is very important. Redundancy has a cost. And over time, when times are good, treasurers, management, boards of directors are trying to iron costs out of corporate life. But redundancy has a cost, and you get the benefit from it when there's a crisis. So you need to build redundancy into your account relationships, your bank relationships, your funding relationships, your liquidity relationships. You need redundancy, and you need to pay a small price for that in order that you have that insurance policy when it happens. The second thing is scenario planning. And we have run sessions in the past year with members about scenario planning and the best practices that some members offer to others for that. Very, very important. You really have to think about bad times. You have to imagine bad times. And then what are you going to do when those bad times hit? And what does it mean operationally? And so you just have to do scenario planning. You have to practice for the bad times. I would say watch lists. Some form of know your counterparty, know your customer, know your banks. Watch lists. Credit metrics, risk metrics. You need a system. Of course, everybody does have a system. Don't get me wrong, but you need to refresh your system. You need to see, hey, how did it do in this crisis? How did it do in the last crisis? How can I improve it? Are we getting the notifications when the watch list is telling us things? Because, we've even had members just in the last few days say, wow, my system actually captured this, but we hadn't turned on the right kinds of notifications. Other members are thinking, maybe I want to buy a third-party system, things like that. So those are really important. And then I would say, finally, excess liquidity. We have run sessions in the past about how any member should calculate his or her minimum liquidity needs. It's very complicated. It can be very quantitative. And our conclusions are, when I say our, I mean our members' conclusions are that we can make formula out of this. We can quantify this, but it's highly dependent on the sector or even the subsector that a company operates in. It's highly dependent on the size of the company, the business model of the company, and the resilience of that business model. And so all of those things have to be taken into account. And once you determine what your good operating liquidity range is, you really have to zero in on the cushions that you need. And that's where your scenario planning and your redundancy come into effect, because you have to, then really think through how much you need and where your alternate sources are going to be in case of emergency, and you have to make sure that they're there. So excess liquidity would be my last point.